Our guest today is Tim Ord. Tim writes the Ord Oracle. He's part of the Top Advisors Corner here on StockCharts.com. He's been a frequent guest on Market Watchers Live. It's always really interesting to bring him on, get his take on gold, on metals, on the broad market. So very interested to hear his presentation. And also, Tim, always a pleasure to welcome a fellow Midwesterner. I'm an Ohioan, recently relocated to the Pacific Northwest. I know you're in Nebraska, so thank you for representing the heartland and charting well.
You're welcome.
Tim. Good to have you on, and looking forward to your presentation.
All right. Actually, I was on this show back on June, I think it was June 12th, just 3 months ago. And this is a chart I presented then. And I was talking about, this is actually a month, the middle chart is a monthly gold chart. And I had some indicators on this, and I'll go through them right now. And what I was predicting at the time, that the pattern that's forming on the monthly gold chart, in my opinion, was the head and shoulders bottom. And I got it outlined. Let's see if I can pull an arrow up here. I got an outline right here. That's left shoulder. In my opinion, that was the head, and that was the right shoulder. And also pointed out, which is the bottom window here, is the Bollinger Band width. And when the Bollinger Band width is real narrow, this Bollinger Band width gets real low. And I noted at the time it was hanging around close to 10. And also I noted that the monthly RSI of gold was above 50, not a lot, but it was above 50. So in my opinion, that we were going to break through this neckline and have a confirmed breakout through this neckline. I noted that probably the market will actually get stronger in the months to come rather than weaker. And so that's why I was saying what was going to happen. And this next chart actually does show what happened. And it turned out that we did bust through the neckline of that head and shoulders bottom, and we did so with a sign of strength. This chart is updated to the 20th of September, so it's about 5 days old, but it's current, and it's everything seems fine. If you notice, RSI is actually getting a little bit overbought here, above 70, but that's what happens normally on breakouts. The RSI gets really heavy, really high, I guess, and that's kind of confirmation. The Bollinger Band width obviously did expand as the market strength busted through the neckline. So on gold here, basically you got, looks like about support around 1325, and we'll see where we'll have some projection to the upside in later charts, but that projection in June turned out to be right. So where we go from here, I guess, be the next question. So we'll try to answer that as these charts roll forward. But at the moment, trends up, RSI, monthly RSI, as long as it stays above 50, the market's considered an uptrend. And normally when you get these Bollinger Band expansions, when you go from narrow to wide, it usually lasts a while. We had one back here back in 2000. The expansion lasted, basically years. Can that happen here? Possibly. I don't see any immediate top other than minor consolidations along the way here, but let me make this visible all the time. So, okay, now this little line here will stay positive, but as it sits right now, the trend's up. So there's no major danger signs at the moment to suggest any meaningful top is happening other than a pullback possibly down to the breakout area, which is around 1325. So trends up. Here's a monthly chart on a little bit narrow. One I want to point on this chart, the market from basically a 2001 low up to 2000 or the 2011 high was around 1900. If you notice, I did a Fibonacci relationship here. From that major low to that major high, the market only traced 50%, right smack at it. And a lot of times, if the market fell back down to around the 900 level, it did a 61.8% retracement, which would imply, if you do Fibonacci studies, if you do a 61.8% retracement, the market only projected to go up to the previous high at best. On a 50% retracement, there's a chance that that consolidation from the 2011 high to the 2016 low was the halfway point of the next move up. If that turns out to be the case here, it would give an upside target around 2,700. At a minimum, you at least go back up to the old highs according to Fibonacci rules. So either you go back to the previous highs at a minimum, or this could mark the halfway point. So either you go to 1,900 possibly to as high as 2,700. So that gives you some projections over the months to come, what to expect. If you notice, when this market did jump through that neckline there, you see that the market just bolted right through it, just virtually a straight line, something we haven't seen for a while. So that definitely was a sign of strength. And also, if you notice the volume jump as it went through that resistance level, which is basically the neckline, did show a big volume expansion, biggest volume we had going back to 1981. So that was a sign of strength through a resistance area, and now that resistance area becomes support. So can we pull back there? Maybe, maybe not. It's really 50-50, I guess. But also I want to point out some, we have some cycle lines here. We got a 16-year cycle and an 8-year cycle. And pretty much every 16 years, if you notice, the 2000 marked the 16-year cycle low, and also the 8-year cycle low. 2016, it also marked an 8-year low and a 16-year low. So we had major cycles come in at 2016. So we're still, as far as the 16-year cycle low, it's still going up. So we think time-wise, we have more time to go up here. Yeah, this is okay. This is still a monthly chart. This is kind of a short-term chart. We're kind of looking at a little bit what could happen here in the coming days. But we noticed we went back in time, and in bull markets, normally 4 months or higher, 4 months up in a row or higher, it usually happened in major uptrends. And that happened at the back in 2007, 2008, 2009, 2011. Even though I was a top, the final top did not produce four days up in a row. Here we have the same thing again. 2018 off that August low, you have 4 months up in a row at a consolidation. We just had 4 months up in a row going into August. You got a little, maybe a consolidation going on here. I don't think anything real serious, but 4 months up in a row happen in major bull markets. So also we got a projection here. This is a Head and Shoulders bottom. You can see a little bit better what's going on. And to give a measured projection of a Head and Shoulders bottom, you take the bottom of the head up to the neckline, and you add wherever that number is, you add that to the neckline. Well, if you do it on here, you come up with around 160 on the Head and Shoulders target, which is higher than where we are right now. So at minimum, we at least probably should head at least to 160, which is not too far from the old high up here around 880. So this is GLD, not gold. So it's an ETF for gold. So short-term wise, we could have a minor consolidation here because we did have 4 months in a row. But since it's been up 4 months in a row, it suggests that the major uptrend is still intact. So if you notice, coming off that August low, 4 months in a row, you consolidate for 3 months. You had another 4 months in a row. Can you consolidate here? Maybe, maybe not. But the trend's still up because the Head and Shoulders projection has at least 160. And actually, we think we'll probably go up to November at this time frame. Not saying September could be an up month, but we don't think the short-term or intermediate-term high has been achieved yet. So we're still bullish on a short-term basis here. So we're holding our long. Going to the next chart here. This kind of gives you a good clue. This chart goes back to 1980. Well, actually 1984 is where the data began. And what we wanted to point out on this chart is ADX, which is it's a month. This is a monthly chart again, and the ADX is an average directional index, and it measures trend strength. And we kind of use it for a little different ways. But we noticed, looking at the long-term charts, we notice every time the ADX, this is a 3-day or a 3-period moving average, but every time it got up around 80, which is where those red lines are, you notice we're not too far from a high. This is a little bit off, but the next one was spot on. That was right close to a high. The 2004 high almost ticked it off perfectly. Came close on 2005. ADX measures the strength in up or down move, and also this picked out this low pretty good, and picked out the 2011 high pretty close, and picked out the fairly close for that 2014 low, and picked out the high of 2016 high. And if you notice, this is current. This chart was 24th, so this chart is updated to yesterday. If we got up to ADX, 3-period moving average, ADX up around 80, we'd have to say that the market's going to head into some sort of a multi-month consolidation phase. And so far, we haven't reached that yet. So we could have, a month or so of consolidation, but no major consolidation is expected right now, because the ADX has not really reached a level where that would be associated with consolidations. So we're talking consolidation like 2004. You went sideways for almost 9 months here when the ADX did get above 80. And this consolidation is about the same thing, a good 6 months of consolidation. So we don't think we've reached the part. I think gold stocks could get, in my opinion, according to the ADX, could get a little exuberant here in the coming months, and we think that could possibly happen in the November timeframe. We put this cycle thing going on here again. This is the 8-year and the 16-year cycle, and the top of cycles is due around, according to the cycle work, around 2022, 2023. So we got 3 years to go, thereabouts, possibly, according to the cycle work. So we'll be watching how things develop. So I think we got room to grow for gold stocks and gold itself. These are XAU. This is a monthly XAU. So gold stocks, we think, are still early in the rally phase and warrant still investments, because we got plenty of time to the upside as far as time-wise goes. We got 3 years out. So anyhow, no major position. According to the ADX, we're not overbought enough to really suggest a major consolidation is near. So we're still on the bullish side near midterm here. This is the weekly XAU chart. This chart was updated 24th. So it was updated yesterday. Here's a possible XAU. This could be an Elliott Wave 5 count. I'm not an expert at Elliott Wave. I keep an eye on it, but our view is this is probably a 5 count up, because 5 counts go in the impulse waves to the upside. 3 counts go into corrective waves. Pattern does look like it fits well for a 5-wave count up here. We're in wave 4, or possibly right now, and could we be breaking out right now? That's a possibility. We have a moving average of the 9, 11, and 5 on the weekly pattern right here. It did come close to a bearish crossover, but didn't do it. So the last time it had a bearish crossover, it came back in April of this year, turned around back up in around that May period, and so far that remains on a buy signal. But we could run into resistance up around eyeballing it here about 11 or 113, 112 range, which is basically the 2016 high. So if you go up there and hit it on the 5 count, that could actually stop the rally, especially if that happens in November. It could imply a 5 count up and stop the market. Excuse us. We also notice that 3 looks a little extended compared to leg 1. A lot of times, if leg 3 is extended, then leg 1 will equal leg 5, and that also puts you up close to that 11 112 range or 113 range, that could be more evidence that the market is due for some sort of consolidation phase. If it does turn out to be a consolidation phase up around that 112, normally you pull back down to the fourth wave 4 low, which is strong support, which is basically the previous highs of 2017. And so 90 be a logical downside target if we did go up to that 112 level. So something to watch for. But on a short-term basis here, RSI, weekly RSI remains above 50. We're holding our long position because we do think we have further to go here. Moving on to another chart. Here's just a silver chart. And actually what it is excuse me, silver to gold ratio. This goes back to 2000 time frame. The top is, the top chart is a monthly chart. This chart right here is a silver chart monthly. It's a RSI on the bottom window, and all it is just a ratio. Previously, when this ratio got down around 0.013, the market was usually at a major low. It happened back in 2003. It happened back in 2009. It happened in 2016. Got a little blurb up. We thought we might go back down there 2018, holding that area. Well, we fell through. So what we did was we stuck an RSI to it. And ironically, when the silver gold ratio monthly RSI gets around 30, that works also well as a major low, which pretty much lines up the previous lows. If we notice, we did get down to that major, or the RSI did get down to that 30 range here. I think it was around June, and turned out it did pretty much mark a low. Was that the start of a major low? In our opinion, I think it is, because normally in gold markets, silver outperforms gold, and also gold stocks outperform gold. And gold stocks in general are moving faster than gold, and silver since June has been moving up faster than gold. So that's what's supposed to happen in bull markets. So we think this silver ratio, or silver, in our opinion, could start to outperform gold. Will it go back up to the old highs of 2011? Not sure, but there's a saying in the market, when the market outperforms to the upside, historically, at some point it's going to outperform to the downside. Well, we outperformed to the upside going into that 2011 high, and now we outperformed to the downside going into, in our opinion, 2019 low for silver. So markets have a way of equalizing each other, but we think silver is actually a good buy here because of this gold to silver ratio. Normally this is extremely cheap on a historical basis. So we think silver in the months to come will play catch up to gold, and gold will rally, but silver percentage wise will rally more, in our opinion. I think we got one more chart here. Here's this is the daily GDX chart on the top window there, and the bottom two windows are kind of unique here. It's the GDX up volume, down volume percent with an 18 moving average, and the GDX with the advanced decline percentage with an 18 moving average. We don't have a lot of precedence here. We tried to take this back as far as we could, but there's evidence that when these two indicators excuse us, reach above 50, which they both did, it happened coming off that. This is a major low 2016, where the market really just accelerated to the upside. That's when both these indicators got above 18, and the market went up another 5 months. If you notice again, we did get above both times on this rally coming off the May low. That in our opinion, this is an initiation of an up move here. that both indicators did hit 50 again. We have since consolidated a little bit, but if the time cycle remains the same, this would give a rise into the November time frame, as far as the 5 months, considering from the point where they got overbought. So initiation uptrend, happened in the S&P's beginning of the year, suggesting a large rally was coming, and we think this is something similar to that. So we don't think the rally's done here. We think the market will move higher above the last high of 31, possibly heading into the November time frame. So we remain bullish. Did get a little bit overbought, get a little bit below zero, in our opinion. This last low, that was probably a pretty decent buying opportunity as far as GDX is concerned. So, that's our analysis. Do I have another? Yeah, I do have another chart here. I thought we had 8, but this is one more. This is a bullish percent index of the gold miners index. Bullish percent index measures the percent of stocks that are point and figure buy signals in that index. And this indicator works pretty well. As long as it stays above 40, the market is considered an uptrend. And when it drops below 40, then the market is due for consolidation. And we just marked with the red lines the buy signals, and they worked out really well. It picked out that 2016 low, picked out that May low. Right now we're up around 75. The bullish percent index is up around 75. That's a 10-day moving average of the bullish percent index, but we're up around 80 range. And in our opinion, that's still strong. The market still can move higher. So we're not, in our view, we're not due for any worthwhile consolidation here, not until the bullish percent index weakens below 40%. So that's more evidence that we're not trying to play every wiggle on gold or gold stocks. We're just trying to play the intermediate term trend and actually the longer trend. But our view, the market will, the gold miners index will break above 900 sometime, in our opinion, before the year's out, because the bullish percent index, the 10-day moving average of the bullish percent index remains above 40. So that's more evidence that the market has strength to carry this market higher. So intermediate term will remain bullish. How high? Right now we're not sure, but higher than where we are right now. So I think that was our presentation. And are you there, Dave?
Yeah, Tim, thanks so much. That was fascinating. Thanks so much for walking through each of those. I've mentioned with a number of guests, just having a chance to watch you sort of walk through your process is really, really cool. So thanks for that. I just want to point out to everyone, if you're for the viewers, if you're not familiar with the bullish percent indexes, if you go to the market summary page on StockCharts, we actually have a section now called the bullish percent indexes, which breaks down each of those. So it's definitely worth reviewing if you're not familiar with that. We had a number of questions come through the chat room that I wanted to just run through with you real quick, Tim, if that's okay.
Oh yeah, great.
So the first one is in terms of correlation. So someone asked about the S&P and gold, and essentially they're in a negative correlation. How do you think, correlations, but a lot of people I think fall into that trap of thinking, all right, the S&P does this, then gold will do that because of a historical relationship. How do you think of that traditional correlation between between stocks and metals and gold, and then the fact that the correlations change? How does that fit into your sort of mosaic of the markets?
Well, I think that correlations, I think S&Ps is still outperforming gold. I watched that chart a little bit. A lot of people put a lot of weight on it. I don't know why gold's going up. Fundamentally, and actually, I'm still bullish on the S&Ps here too. I think S&Ps will be, we're talking that you're 5. Are you talking 5% before the year's out, or for you were going to ask me the question about where you think the 5% move will be for the S&Ps, or that's
a poll. That was going to be my next question to you. How would you answer it? So is it the next 5% move in the S&P higher or lower?
Are you talking about year end?
Through year end, yeah, that's right.
Well, because I actually think the October or the let me pull it. The August low will be tested before the year's out, but also think that the market will close at a new high above 3,000.
Tim, you're breaking my poll. You're answering both.
Yeah,
but you might be right.
I think October could be a kind of slap in the face. Then from there, we rally pretty good all the way into year end. That's what I'm starting to see, because I think this rally we got going, or trying to attempt to get going right now, may break above the 3,000 level just to get everybody sucked in. And I think that could turn into some sort of a high, but not a major high. So
you alluded to what's going to be my next question, which is, you mentioned a couple times, sort of subtly at times, about the seasonal trends, right? So we're in September, October, tends to be pretty weak for stocks, right?
Right.
How do you think of the seasonality of where we're at relative to some of the other signals? How where is that in priority wise when you're thinking of a market outlook?
Well, actually, to me, I kind of measure strength. I look at panic and the ticks and trends and stuff like that. More seasonality, it's in the back of my mind, but I really don't make a trade decision on it. I watch where I am in that seasonal period. But the worst thing you could do probably here is break a new high in September, October, and that's not usually the time you want to see that. So
right, yeah, that's right.
That's how I view it. Not saying that's the sell signal up because it's a new high in October or something. I'd have to have more evidence than that, but
sure.
I think there is going to be some sort of a high here. This rally, I think that actually starting today could last for 2-3 weeks into some sort of a new high above 3,000.
Yeah.
How high? Maybe 3,050. I don't know, but that area could be a danger level, because I don't think we're going to keep going.
Sure.
Then back down again and possibly test the August lows and back. So I don't know. That's too much information, and it's too much.
Your world is very volatile
here
right now, Tim. You're giving me a very volatile feel for the next couple months. So
yeah. So it's
fun ride.
One step at a time. Right now, we're actually along the SPX, and we're along the gold market too. So both of them, I think, are going to go up here. So
we have time for just one more question, Tim. This comes from one of the viewers. They asked about the dollar. You didn't talk so much about the dollar. How do you think about the dollar here? Does that weaken as gold rises, or how do you think of those relative to one another?
I used to do all the correlation stuff and try to determine a decent trade signal out of that. I kind of just gave up on it. And actually, right now, I try to actually keep away from the dollar, not saying that it's a reliable indicator. The correlations to me didn't really set up, because I seen gold rally with the dollar rally at the same time. Right. And I seen gold go up and dollar go down. And so to me, it lost a lot of its luster for a predictable outcome. So it's to me, it doesn't give me enough. It's not a trade signal I look at anymore. I quit watching the dollar, anticipating the dollar going up or down, because I seen dollar go up and gold go up, and so that correlation is not as accurate as I like to have.
It's a really, really good point. I'm sure you're familiar with Bob Prechter's work to some degree, but when I've spoken with him about that, he always talks about the dangers of making direct comparisons between two asset classes, only because it never happens in a vacuum, right? There's so many other things at play, and geopolitical risk and just general market psychology and all these things that could drive any two assets. And it feels like in the rear view mirror, the reasons why that happens tend to become very clear, but at a time, it's pretty challenging. Listen, Tim, thank you so much for coming on today. This was a really cool walkthrough, and the charts of gold are things I look at, and as you're talking, I realize I don't look at them nearly enough. So thanks for sharing your wisdom and sharing your outlook for the next couple months. Appreciate it.
All right. Thank you. Thanks for having me on.
Everyone, that was Tim Ord. Tim Ord is a great expert on gold, on metals, on the S&P. He writes the Ord Oracle on StockCharts.com. If you go to the top advisors corner, you can get some of his outlook and follow some of his work more closely. Thanks so much, Tim, as always, for joining us on Market Watchers Live.